Earnings drive the stock market, but this past week we've got news around the election and a possible vaccine. I'm Charlie Toole, a portfolio manager with Advisor Investments. Join me and Jeff DeMaso, our Director of Research, and Steve Johnson, portfolio manager, as we discuss not only earnings, but the impact of the election and vaccines.
Hello, and welcome to another Advisor You Can Talk To podcast. I'm Jeff DeMaso, Director of Research here at Advisor Investments. And today I'm joined by Charlie Toole and Steve Johnson, co-managers of our dividend income strategy. Charlie and Steve, welcome back to the pod.
Happy to be here.
Thanks, Jeff.
All right, glad to have you both because I know it's earnings season when companies report on how the past quarter went and tell us what they think the road ahead will look like, which is a busy time for both of you. That said, earnings season this time has been overshadowed by a different season, election season. And we're not quite out from under that election shadow just yet. So I absolutely want to discuss earnings season and get your take on what you've heard so far. But I think we need to start with the election. And then I think we also need to touch on the pandemic and some of the news around a vaccine that we heard just yesterday. And then we'll get back to earnings season. So it is Tuesday morning, November 10th, just because things are moving quickly in the news. Let's timestamp that. And it looks like Joe Biden is going to be our next president, but that the Republicans have held on to control of the Senate. So it looks like we're going to end up with a split government. Of course, neither of those are a completely done deal yet. And it's only been a week since the election, but still, Charlie, let me start off with you. How have markets responded to that news about the elections and what it looks like we're going to get from a split government?
Well, Jeff, we've had a response that's just about as good as we could have hoped for. I think that coming into the election, both sides were saying that if the other side won the president election, the market was going to crash. And last week, the markets actually had a great year. The S&P 500 was up 7%, technology stocks were up nearly 10%, healthcare stocks up 8%, and small cap stocks were up 7%. These are returns that you would consider an average or maybe even an above average year, and we had those just last week. I think, as you mentioned, the split government with the Democrats controlling the White House and the House of Representatives and the Republicans controlling the Senate was seen as a positive for some specific sectors. One of the big winners was healthcare. I think that having a divided government means that dramatic changes to the current healthcare policy is off the table. And we saw a lot of stocks in the healthcare sector rally on the day after the election. Health insurers were up double digits on the day, and some drug makers were up as well. But on the flip side of that, having a divided government means that some things might not get accomplished, specifically stimulus. And so I think you saw some sectors that are leveraged to infrastructure spending not do well. Stocks like Caterpillar and Deere, those were both down on the day. And the bond market initially shot up, but then came back down. And I think the bond market was saying that there was likely not going to be another stimulus package at least until next year. So that could weigh on growth in the short term.
Yeah, you're right. We've got that, kind of good year in one week. Are you surprised though? We didn't know the result of the election the next night, and we really didn't know. No one was declared a victor until, Saturday. Were you surprised that we have this kind of drawn out count that we didn't get some type of market sell off at all?
Yeah, I think investors did a very good job anticipating what would happen. I mean, I think the pollsters were not even close to what actually happened. But I think the market, that as the votes started to come in and the votes that were outstanding or still left to be counted, there was a way that you could project where that was going to go. And so I think in most of the close states, it was the cities that were taking a longer time to count. So, for example, in Pennsylvania, a lot of the outstanding ballots that needed to be counted were in Philadelphia and Pittsburgh, and those were at least estimated to be votes that would be in favor of Joe Biden. So I think that that's the market sort of looked through where we were at the time and anticipated where the ballot counts were going. And the market is not always correct when it prices in news, but this time it looked like they were.
Jeff, and the other thing too is I think we were pricing in, or at least the stories were dire, right? That there would be violence. We saw Boston and Newbury Street in New York, so the stores being boarded up, and the next morning arrived, the market went up, everyone went on with their day. It seemed like clearly we didn't get all of those negative consequences. And with that, I think there was a sigh of relief, and people felt like, we'll focus back on the virus and some of the economic news.
Yeah, I think that's a great point, Steve. We didn't get that worst case scenario of violence, and I always like to say that the market's pretty good at pricing in or dealing with, maybe is a better way to say, uncertainty that it can see coming. We saw a contested election, a drawn out count potentially coming, whereas COVID is a great example. Kind of came out of nowhere and had a much bigger, market impact on the downside there. So you mentioned the pandemic and turning to that. Let's pull on that thread a bit. We got some positive news on a vaccine from Pfizer and BioNTech last night, or I guess yesterday morning. Was the market pricing that in? What was? I don't want to necessarily focus on short-term market action every time here, but what was your takeaway from what we've seen?
Jeff, yesterday, in all my 20 some odd years of doing this, yesterday was probably one of the most interesting days I've witnessed on the back of that Pfizer news. And clearly, we've talked about a vaccine, but the market clearly didn't price it in, because what we saw yesterday was very interesting. So in fact, talk about dispersion. We saw Carnival Cruise Lines, the stock was up over 39% for the day, whereas we saw a stock Biogen be down 28%. So that dispersion of 67%, one of the widest we've seen on record. And just the overall market, we saw this massive movement out of the stay-at-home stocks and into more of the value kind of traditional cyclical small cap names. The Russell 2000 yesterday outperformed the NASDAQ by over 5%, one of the largest moves ever in history. So clearly, the market, even though there was an expectation that we'd see a vaccine, we saw these real kind of huge moves in different parts of the market. So we saw banks rally over 15%. Obviously, as you would expect, airlines and, as we mentioned, cruise lines doing very well, but also big moves in the bond market. And we saw, triple C rated bonds. This is something I know that you follow quite closely in the high yield market, but triple C rated bonds, we saw their yields fall to the lowest since 2014. We saw one of the biggest one-day plunges in borrowing costs since 1996. And in fact, the junk bond index, we saw the yield go to 4.64, which is,
Can't call that high yield anymore.
I don't know what to call it, to be honest with you. I mean, if you're looking at 4.6% for high yield, so clearly, that vaccine news, and gosh, even though we saw that it was real positive, we don't know, obviously about distribution and the impact of other vaccines. So we know Moderna has a similar technology, but you know, clearly the market was caught off sides. And so, which led to these real big moves. And I guess the question for us now is this something that will continue going forward? Or is this simply just a byproduct of that news for one day?
That was exactly the question I had in mind was, does this mean the work from home trade is done? We've talked a lot about how the pandemic pulled forward a lot of trends around whether it's working from home or shopping for groceries online, kind of that move towards digital. Does a vaccine just spell the end? Do we kind of go back to where we were? What do you guys think?
You know, I wish I had the answer to that, Jeff, because that is going to make someone a tremendous amount of money over the next weeks, months, and probably years. But I do think, as you know, we've been talking about the growth trade for months. And we've talked about how, the market was driven by large cap technology. And you could say that there was some froth in some of those names that perhaps is being let out, but clearly those trends aren't going away forever. So, whether it be working at home, remote education, shopping online, those trends aren't going to go away. So clearly, you know, I think part of it is that the sectors that did the best yesterday were obviously the ones most impacted by the virus and suffered the most. And so now you're just getting back kind of that reversion to the mean. And the question will be how successful the vaccines will be, and will they change the behavior here? Will people feel the need to go back out again, and will they start booking airlines and cruises? And I think that's the what we'll be have to look for in the data. I guess the concern would be that people let their guard down though, and you know go out and start doing that, and we see maybe a third wave of the virus. So I think it's too early to tell, but it is encouraging, especially for anyone who believes in asset allocation and diversification, that some of these other sectors and have started to outperform. And gosh, that would be great to see going forward.
I think one of the things that's going to be interesting as we move forward as well is, Jeff, I think you mentioned a lot of these work from home or technology trends pulled forward a lot of demand. And we've been talking a lot about the comparisons, the year over year comparisons that we're going to start to see next year. So, as we get into the first quarter and the second quarter, companies are going to be comparing their growth in that quarter versus the growth in those quarters in 2020. So, the year over year growth will look good as the economy's reopened compared to when it was shut down from the height of the pandemic. Well, the opposite is true for some of those technology companies. So, a company like Netflix or Domino's Pizza or Activision, that's a video game maker, those companies pulled forward a lot of demand. And now, when we get into next year, they're going to be comparing to the height of that demand pull forward, and their year over year growth metrics won't be as good. So, it'll be interesting to see some of the winners from this year because of the pandemic. Their growth rates are going to, they have a higher hurdle to clear next year in the year over year comparison. So, it'll be interesting to see how that plays out.
I think that's a great point, Charlie. We often focus on those companies that are going to have an easy comparison to get over, but there are some that are going to have a higher hurdle. So let's use that. Let's pull on that thread. We've talked a bit big picture and environment, and we can now pivot to earnings season and bring it down to the company level. What trends have you seen in earnings season so far?
Jeff, I think one of the most positive developments, I think, is that we're starting to see a return of companies give guidance. There were a number of companies that did not give guidance because there was so much uncertainty. But now more and more companies are comfortable at least giving guidance for the fourth quarter. They typically don't give guidance for 2021 until January anyways. So that uncertainty is the same as it would be in a normal year. But I think there were more and more companies that were not giving guidance that have started to give guidance. So there's a little bit more clarity that management is seeing. And I think that's a positive development for just the overall health of the economy and the recovery of the economy.
Yeah, I completely agree. I've been talking about this quarter as being like the quarter where a lot of uncertainty gets cleared up, whether it's around the election, vaccine news, and to your point, around earnings. Speaking of clarity, though, and getting a sense of how bad things have been, I know banks had some news around the losses they were taking. What did you see there?
One of the biggest concerns with the banks has been the credit losses that they have to book. And so when the economy starts to slow down, people start to lose their job, they have a difficult time paying back their loans. And so what banks will do is they'll reserve money or set aside money to cover those bad loans. And we saw a lot of banks set aside billions and billions of dollars. And when the economy starts to recover, people start to get jobs and employment starts to grow again, banks will take those reserves that are held for the bad loans and bring them or pull them back onto the balance sheet. And when that happens, that money falls straight to the bottom line. So, one of the things that we're seeing is that banks are now saying that loans are being paid back, credit is improving, people are starting to get jobs. The unemployment rate is still high, but it's falling. And instead of setting aside money to prepare for more bad loans, they're saying the loans are actually in good standing, and we're going to take that some of that money and bring it back onto the balance sheet and have it fall right to the bottom line as profit. So the banks are starting to see an improvement in their credit metrics for the loans that they have outstanding. And that was a big surprise that many analysts weren't forecasting.
Yeah, kind of idea that things weren't as bad. I mean, they weren't good, but they weren't as bad as what the banks had prepared for, it sounds like. Steve, I want to make sure I get your take on earnings season, some of the trends that you've been paying attention.
Yeah, well, Jeff, I mean, I think we've pointed this out before, and as Charlie mentioned about analysts getting it wrong and not to throw them under the bus again. However, if we look at this, with 90% of the S&P reporting here, we've seen, 86% of those companies reporting a positive earnings surprise. And it's over 75% are also declaring a revenue surprise. So again, we've seen the estimates were too low, and now we've seen this recovery, especially in certain areas, the consumer staples. So the packaged goods names, the Procter and Gamble's of the world, they reported great earnings. Pepsi, they were able to issue guidance, as Charlie mentioned as well, because they have clearly been the beneficiaries. Where we've seen some of the other names in the let's say the commercial real estate market not so be able to report not so great numbers. And I think that trend is, clearly we mentioned comparisons, and those banks are going to have easier comparisons in the first quarter versus some of those growth names are it's going to be difficult for them. And so when we look at this, I think you have to be very careful about looking too far into the future, because clearly I think we don't know yet what the impact will be on behalf of the consumer, and we'll see where companies are reporting. So I do think there are positives to look forward to, especially in some of these earnings trends and the fact that they weren't as bad as analysts expected. But I think we're going to have to look at the guidance and to see if they're able to maintain that guidance through the fourth quarter.
Yeah, I think it's clear that the pollsters weren't the only ones that get their estimates wrong. The analysts did as well. Uh, Let me pull on that thread there that you're talking about being careful about looking forward, and maybe play devil's advocate here on just asking you about earnings trends. We've got a potentially new president in the White House. We've got potential vaccine. How relevant is the past quarter or the past two quarters in terms of what the future might hold? Could we be in a very different environment?
Yeah, I mean, I think we clearly could be. And I think that's a good point, because I think we're all trying to guess what the world will look like here in 6 months or 9 months, and what the impact of the vaccine will have. And clearly, as we've seen in some of these moves yesterday, as I mentioned earlier, with banks up 14, 15% on the day, uh, the market wasn't expecting this news, or perhaps wasn't expecting it to be as good. And so, to your point, is there an upside surprise in the future now that we have political clarity? We've seen the vaccine coming. Charlie mentioned, obviously banks and their performance, which tend to be a very good indicator, a leading indicator of the economy. And so, you can make the case, I think, for being optimistic going forward. Um, Clearly there are potential landmines ahead. As we don't really know kind of about the virus, and could we see a third wave? We don't know what the political implications will be of President Biden working with Mitch McConnell and the Senate. But you know, a lot of the uncertainty that you mentioned is now gone, and I guess the only concern would be, as it relates to that, is the market getting ahead of itself, and are we, pulling forward those gains? With the market up, I think over 11% right now, the question is there any left as we go forward?
Yeah, a little surprising, I think, to see the market up as much of it as it is in a year that has had the pandemic and the economic hit to it and earnings. Um, Charlie, kind of any wrap up comments on earnings season or big takeaways that we've missed?
No, I think just to reiterate the point that Steve just made, Um, I think all the unknowns are known, whether it's the virus, the election is the uncertainty there is going away. A vaccine has at least proved to be effective, so I think that that's good. But to Steve's point, how much did we pull forward? I think the big thing to watch will be what happens in Washington. I know we've been advocating and talking about another COVID stimulus bill and an infrastructure stimulus bill with divided government, how much of that stimulus will be passed and what impact will that have on the economy going forward. One of the big things this year that has helped the market is the amount of stimulus that the Fed and the government had passed and put into the market. It'll be interesting to see how the market reacts to less stimulus going forward if that's the case.
Yeah, I think listening to you too, it's a great reminder, and I always come back to this, but just how difficult it is to time the market. I mean, last week the election results were in doubt, and European countries were heading into lockdowns, and stocks went up. And yesterday we get positive vaccine news, and stocks go up again. So just trying to predict this market is so difficult. I appreciate the positive, optimistic look that you guys have taken on some of the events we've seen in the past couple weeks here.
Yep. Well, thanks, Jeff. And I think, going forward, a couple of things that we're going to look at, you know, continue to look at earnings, but also bond yields. Again, we saw bond yields move up yesterday. We'll see if that becomes competition for stocks at some point. Bonds yields haven't offered much competition. And then the other part, I guess, is as we mentioned earlier about technology, can the market continue to move higher without that leadership? And will there be some new leaders as we go forward? And that'll require some positioning on perhaps of some people's portfolios who have been overweight technology for several years now.
Charlie, anything you want to say to that?
Well, the only thing I'll add to that is, you might have a big change in the dynamics of what's going on in the market. And to Steve's point, you might have the overall market be flat, where the technology sector is down, but some of these other cyclical sectors will be up. And so you might see, we've used the word a lot, bifurcation. The bifurcation in sector performance might reverse, and you could see a flat market, but you could have some sectors that do very well, while others like technology do not.
Yeah, I guess every strategy, every sector gets its time in the sun, and trying to time those changes can be difficult. But staying diversified, make sure you've got exposure, to all those different parts of the market without having to make an all-in bet on one or the other. Charlie and Steve, thank you for joining me today. This has been Jeff DeMaso, Charlie Toole, and Steve Johnson from Advisor Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe and review our show. You can check us out at advisorinvestments.com/podcasts. Your feedback really is always welcome. If you have any questions or topics you'd like us to explore, please email us at info@advisorinvestments.com. Once again, I'd like to thank our editors, Kaylee Steele and Ashlyn Melvin, for making this podcast a reality. And thank you very much for listening.